The recent decision by the European Commission to stop the merger between Siemens and Alstom has started a discussion how the EU can increase its competitiveness in the global market. Some claim that only by creating European champions, Europe can challenge the dominant position of the US and China. Others, like Oscar Guinea, senior economist at ECIPE, argue that good regulations, together with healthy competition and industry policy, are essential for their businesses to thrive.
Competition, like regular exercise, is good for the health of the market economy. And the healing properties of competition are two. The first one is that competition encourages the least efficient companies to leave the market. And this is good because it improves the allocation of labor and capital to the most successful companies. The second one is that competition is good for innovation. Competition encourages the investment on innovation and also incentivizes companies to take on new technologies. The way we measure the state of market competition in Europe is looking at three metrics. The first one is market concentration, then it's market power, and economic dynamism. Market concentration, which is the market share that is captured by a reduced number of companies, has been increasing in Europe for the last years. Where? In sectors like telecoms, air transport, or postal is where we find the highest levels of market concentration. These are network industries that they require a higher levels of investment and they naturally have fewer players. But surprisingly, we also found that there was quite a lot of market concentration in sectors that we didn't expect it to have. So sectors like information service activities, like data hosting or data processing in Germany are supplied by 75% of the market is supplied by 10 companies alone. Half of the market in private service employment activities in Italy or Spain, or half of the tourism industry in Poland is supplied by 10 companies. Regarding market power, which is the difference between the cost of producing and providing the goods and services and the selling price, we found that in the period between 2008 and 2012, on average, market power was declining. And we also found that market concentration was going up. This is more or less what we expected, because this is at the moment with the heights of the financial crisis. There was a fall in demand, markets become more concentrated, and firms have to reduce the margins. But very interestingly, at the same time, we found that between 2008 and 2012, one of every 4 sectors, we found more market concentration and more market power. We also found that the companies with the highest levels of market power, of markups, the ones that were charging the higher prices, the commercial margins were going up, which was telling you something about the market power of the most successful companies. And finally, we also found that the market power in services, in things like industries such as management consultants, legal services, accountancy, or real estate, were between the highest across all the sectors of the economy. In our study only has data until 2012. So it could very well be that after 2012, the economy has recovered in Europe and competition has resumed. This is not what we really found. We look at economic dynamism, which is the sum of the number of companies getting into the market and the number of companies which are closing. It's sometimes referred to as business churn. And what we found is that the level of economic dynamism in Europe, the ecology of the market is declining. And this was declining after the crisis and have not really recovered to the levels before the crisis. Now, the 3 reasons why this could happen. Why do we have higher levels of market concentration and why do we have higher levels of market power? The first one is fixed cost. So markups, the difference between the marginal cost, the cost of producing the goods and services, and the price are not equal to profits. It could be some other things like investment in machinery or investment in intangible capitals, things like advertising, reputation, marketing, research and development, patents, or the ability to navigate red tape that could be eating away those profits, making the appealing of getting into this market much lower. The second thing that could be explaining the increase in market power and market concentration and the decline of market competition is digitalization. And there are two factors of that. The first one is zero marginal cost. Many of these digital services are free. Well, not necessarily free. You pay for the data you hand over to the provider, but they are free of charge, which means that the classical trade-off between quality and price, the trade-offs that we all face when we go to the supermarket, disappear. There is no difference between the best messenger provider in your phone and the second best. They're all free of charge. So you choose the best one, and we all do the same, which generates very strong dynamics of winner-takes-all competition. The second is network externalities. If you benefit more from the use of a service because they have higher number of users, then the opportunity cost of switching increases, and then you stay with the same provider. However, if it was digitalization, technology, patents, research and development that was really pushing the increase in market concentration and the decline of market competition, we will expect to see higher levels of labor productivity. And we don't find this in the data. We find that for many sectors in Europe, productivity has been flat, has been declining, or is going up just a little. So there must be something else. And another reason why we think there's been an increase in market concentration and a decline in market competition is regulation. Regulation affects all the companies the same, those who are inside the market and those who are outside. But in a way, regulation creates barriers because the companies which are inside the market, they are better prepared to adapt and to influence the regulation. Regulation is not necessarily bad. This is not my point. It could be very good reasons why we have regulation, health and safety, or the need to fix a market failure like pollution. The point is that the regulation creates an asymmetric cost, and that cost is a higher burden for those companies which are outside the market, which are not represented, they cannot voice their concerns, and they cannot really influence the regulatory process. The second way in which regulation can impact the economic activity is that if companies profit from a change of regulation, then there will be a change on incentives to invest, from investing on innovation to investing on lobbying, to investing on shaping the regulation to take advantage of it. And if there is a decrease in the investment on innovation, that has a negative effect on labor productivity, and lower labor productivity means that we have lower levels of economic growth and prosperity. We have been looking at what's the state of regulation in Europe, and we saw two things. The first one is that there's been a decline in the efforts to reduce regulatory restrictiveness in Europe. Every time it's more difficult to make market more liberalized. And the second thing we found is that in the member states where there's been a genuine effort to make markets less regulated, particularly in those countries which have been highly affected by the financial crisis, the effort there has been on making those markets work better, but not necessarily on making them more contestable. And by contestable or contestability, I mean the cost of new entrants to get into these markets. We have tested these things empirically, we have looked at the data, and we have found three things. The first one is that there is an association between regulation, market power, and market concentration. Higher levels of regulation leads or are associated with higher levels of market concentration and market power. And this relationship works also in the opposite way. So higher levels of market power and market concentration also leads to higher levels of regulation. The second thing that we found is that market concentration, market power, and profits, they are all related. Companies which operate in markets with fewer players, which have higher levels of market concentration, they also have higher levels of market power. And because they can charge prices above the marginal cost, that has a positive effect on the bottom line, on the profits. The third thing that we found is that markups cannot be explained alone by fixed cost, by the need to recover the investment on machinery or on intangibles, because there is a relationship between markups and profits, and this relationship is statistically significant. So what all these things have to do, the state of market competition in Europe and regulation in our debate on the EU industrial policy. So these things are important for two reasons. The first one is that competition matters. Competition is good for competitiveness, and competition can achieve the same things that the industrial policy seeks to achieve. Competition can encourage low productive companies to leave the market, increasing productivity. Competition can encourage companies to invest in innovation and take up new technologies. And here, our findings shows that in some sectors, the level of competition in Europe has declined. The second thing is that contestability matters. If we want to weaken, to reduce the stringency of competition policy in Europe, to help the emerge of industrial champions, we should be very aware of the regulatory context in which these companies operate. The risk is that if we allow the emergence of industrial champions, these champions will stay in the market independently of their performance. They will be champions, but they don't necessarily need to be the most efficient companies. All in all, competition matters, contestability matters. If we don't take account of these things in our industrial policy, in the debate on competition policy in Europe, we are at risk of having higher levels of market concentration and market power, which will have an impact, a negative impact on the overall amount of innovation and on the quality and the price of the goods and the services. The question is, which are the incentives to innovate when your market is captive? They're none or much lower. The risk is that you bet on industrial champions and you get monopolies instead. There are other tools. If we want the most innovative European companies to flourish, we need to give them the space. And that means that we need to deepen in and continue work on our single markets, reducing the regulatory barriers so companies, champions can emerge by competing between themselves and not by artificially merging. And this is very important for services, and it's very important for the digital economy, because companies need to scale up without having to tweak the business models 27 times.